Before you apply for business credit, lenders already have an opinion about you based on a few key factors. And those factors determine whether you get approved for $5,000, $50,000, or $100,000 in business funding. So in this video, I'm going to show you what lenders look at so you understand how they evaluate your business credit applications. Let's begin. So most of you, if not all of you, are looking for clarity around maybe why you may be getting denied, why you're not getting the approvals you're looking for, or maybe before you even start the application process, you want context, clarity, and confidence going into the process about what to expect. And this video is going to break that down and so much more. So I'm going to show you guys some of the different factors that affect your funding decision. So these are all of the different key factors that lenders are looking for, from personal credit to business structure, relationship capital, industry risk, and cash flow. And I'm going to start off first talking about personal credit profile, which is the foundation of most, if not all, funding decisions that goes forward. Now, the first thing that lenders evaluate when you are applying for business credit is your personal credit profile. And the reason why is because big banks need some type of collateral to loan you the money against. And that's either going to be cash flow that your business is generating. For most of you guys who are starting off as business, maybe you're not generating enough to where that's where your personal credit comes in, where you now have to be the guarantor to say that if the bank gives you $20,000 and for whatever reason the business can't pay it back, they can now come after you directly as the personal guarantor to fulfill this debt. Obviously, we're gonna make sure that you take care of the debt that you get, so you never have to worry about that. But at least you now have the understanding of, what that means and what that entails. So once again, personal credit is the foundation, right? As you can see by this graphic here. And when you are building on shaky ground, when it comes to leveraging your personal credit to get access to funding. Now, in terms of what lenders want to see when it comes to the structure of your personal credit, they want to see that you have 100% on-time payment history, okay? That you've never been late on any accounts. And if you have, you've gone through the credit restoration process to have those things removed from your report, that you have at least 3 to 5 personal credit cards. And on those 3 to 5 credit cards, you have at least a $7,500 limit or higher. I'll even highlight this on each of the cards. Now, the size of the limit matters because lenders do use your personal limits as a benchmark. In other videos, I've referred to it as comparable credit. So they're going to take the average limits that you have on certain personal credit cards to determine the size of limits they may give you on business credit cards, which is super important. Also, and I mean, this pretty much ties into what I just said. Once again, the lower your limits are on the personal side, it just puts a ceiling over how much funding you can get on the business side. Now, when it comes to credit history, right, you want to make sure that you have at least 18 to 24 months, right? So you're anywhere within that 1.5 to 2 year range before you actually start going out and applying for business credit, because the newer your credit profile looks, the more high risk you as a personal guarantor look to the lender, to where they may use that against you to either not approve you or give you smaller limits. Inquiry count. Now remember, Experian, TransUnion, and Equifax are their own 3 reports. So you will see that sometimes you'll have 1 or 2 inquiries on one credit report and none on another report, and then like 7 on a different credit report, because different lenders pull from different credit reporting agencies. But across the board, you never want to have a lot of inquiries on your report. The more inquiries you have, especially in a shortened time period, the more of a risk you look to lenders, because they don't want you to come off as though you need the money. You want the money so that you can grow your business, but you're not desperate for it to where you're applying everywhere under the sun to get approved. And you prevent that from happening by, once again, decreasing the limits that you have, the size of limits that you have. Profile, once again, your personal credit profile is the foundation for a lot of the other things that we're going to talk about here in this video. If you do not have a strong personal credit profile, it makes it that much more difficult for you to go out and get approved. Now, let's take some time to talk about number 2, which is business structure. Okay. Lenders are, of course, looking at your personal credit report, but they're also looking at the business that you're looking to get them to fund. And you want to make sure that your business looks as credible, as legitimate, and as consistent across the board, so that you're not just getting approved, but that you're getting approved for the size of the limits that you're looking for. So what does that look like? Well, that looks like making sure you have a business name in place, right? So that your entity, whether it's an LLC, S Corp, C Corp, it's there and it has a name to it. Making sure that you have a business email, a business phone number, a business website, your EIN, okay, and your operating agreement. Now, having all these things in place is extremely important, because once again, it tips the scale paired with what we talked about on the personal credit profile and you getting bigger limits. Can you get funded if you just have, because I know the big 3 that most people have, because you literally cannot have an entity without an EIN, an operating agreement, and an LLC, like the actual LLC, right? Your articles of organization, which I think isn't listed here, but I'll put that here, right? So your articles of org, which is pretty much the entity. I'll call LLC, but it's really the entity, right? You can't even move unless you have these 3 things here. And for most people, you guys do have your articles of organization, your operating agreement, and your EIN, right? Can you get funded with just those 3 things? Yes. But if we want to maximize our chances and operate in best practice, you want to make sure that you have a full profile from top to bottom, not just the LLC, EIN, and operating agreement, but the other things that make your business look credible and legitimate as well. Because the stronger your structure paired with a good personal credit profile, the stronger your approvals. Now, number 3, let's talk a little bit about relationship capital, because this is also a big one. This is a multiplier in this entire process, if you will. Now, I'll explain what that means in a second. Most people think that once they have their personal credit in place and their business structure in place, it's off to the races. Which, can you go out and start applying for business credit? Yes, but that would be a bit premature. And the reason why I say that is because lenders, especially in today's lending environment and lending market and lending environment, lenders very much so care about your relationship with them. Okay. Now, you build this relationship capital very, very simply through opening accounts with these banks, making consistent deposits in there, spending time with the bank, just banking with them for as long as you possibly can, so that you look better and more credible in the eyes of the lenders, so that when it's time for you to apply, they know that you're not just going to take the funding and then bounce off to go work with a Chase or any of these other lenders, but that you're here to stay. And another important thing when we talk about putting ourselves in position for higher limits, okay, the relationship that you have with a bank is internally being tracked by that bank using what's called a bank rating system. So the more consistent and the larger that your deposits are, and the more consistent you are maintaining the account overall, you go from putting yourself in position to just get $5,000 to $10,000 approvals to now you're getting $25,000, $30,000, $35,000 approvals and beyond. Forming this relationship capital and building it up is super duper important here, to where if you took two people, right, both of them had the same exact credit, the same exact business, same exact structure in industry, but one person, and they both went to the same bank. One person has no deposits, but another person has been depositing $5,000, right, for the last 5 to 6 months. You have this situation here where you have the first person where no deposits and they're only getting approved for $10K, but the person over here is getting approved for $25,000 and $35,000 limits and beyond. So if you knew that the difference between you getting a smaller limit and a large limit was simply you just taking time to make those deposits over at least a 3 to 6 month period, would you do it? Because I know, speaking for myself, I definitely would. Now, number 4 is going to be industry risk. So this is a big one that I don't talk about too much on this channel, but I do get questions about it enough to talk about it now, which is, how do banks and lenders see you? Every business is classified under something called an NAICS code. NAICS is an acronym that stands for North American Industry Classification System. And this is pretty much a system that tells banks what industry you're in, and they in turn use that industry to reverse engineer how risky of a business it is that you are running. Because once again, banks are in the business of lending money, but they also want to do so while minimizing their risk. So I'll give you an example. You take the two people we talked about earlier, same credit report, they're down to build relationship capital, all these amazing things. But let's say instead the differentiator between the two is that they are in two different industries. So you have one person that's a fix and flipper in real estate, and another person that owns a brick and mortar. So they have an actual building where they run their accounting services out of, right? Same person, same data point, same request, just different industries. To the lender that they're applying for, which will be the exact same, in the eyes of when it comes to the accounting firm, it looks stable. It looks predictable because it's a low risk industry. There's an actual physical location to it. The lenders know that this person is going to actually be using the capital for different things that are happening within the business. This person seems a lot less risky compared to the fix and flipper, where if you know anything about fixing and flipping, especially in real estate, and then once again in this market, has a high level of volatility, to where the bank is going to be sitting there sweating like, okay, if we give you this money, are we going to go ahead and give it back? So that's not to say that you should lie and say that, well, if I am a fix and flipper, but I'm going to tell them I run a consulting firm or anything of that sort. But what that is to say is you at least now have the context to understand how the industry you're in may also be hurting you or helping you when it comes to putting you in a position to get higher approvals. Some of the high risk industries that I've heard, certain real estate models, trucking, right, logistics. Lower risk industries are usually like things around professional services, accounting, insurance, marketing agency, consulting businesses and beyond. So I'm not, once again, advocating for you to change your business, but now you understand how banks may have been viewing your business all along so that you can use that to navigate your steps going forward. The next one is going to be cash flow, revenue, and consistency. Now I want to answer this. Does your business need revenue for you to get funded? Absolutely not, it doesn't. But if you have revenue and everything else, now you look a lot more premium in the eyes of lenders that you're looking to work with. Cash flow helps because it lowers lender risk. It expands the options that you have available to you, because now you can start looking at certain business line of credit options, right? And it increases your approval amounts, especially if those deposits, going back to what we talked about up here, right, with this relationship capital, those deposits are being deposited into that account of the bank. It's incredible, right? It's a good sign for them, and it's just going to increase your internal bank rating score for yourself. So when it comes to going out and having that revenue consistency, do you need it to get funded? No, but if you do have it, it does open the door for you to potentially start looking into traditional funding. And I'm not talking about traditional in terms of like business credit cards. I'm talking about like actual loans, right? Business lines of credit and other alternative financing options that most people may not be able to get access to because their business isn't doing at least $5,000 to $10,000 a month in revenue. But more importantly, they're not showing that it's consistent, and they're also not showing that the revenue is flowing through that same bank that you're looking to apply with. So does revenue replace credit? No, but it definitely enhances what you're able to do by leveraging your personal credit and getting access to business credit cards. Because when you have revenue paired with everything else that we talked about earlier, now the world is your oyster, to where you could either go the route of I want to get business credit cards, or no, I want to get revenue-based lending and get access to more lines of credit, or maybe I want to get both. But now you have the context to understand what that process looks like, being ingratiated in all of this going forward. So family, as we close, if you receive value from this video and you want help building your personal credit profile, structuring your business correctly, and creating a funding strategy that actually gets you approved for high limits, that's Takeoff University. The link for that is going to be in the description, so you can learn more about how me and my team can help you get to the other side of success. But as always, my name is Marvin Francois, and until next time, peace.